Welcome to Poor Millionaires. Today's guest is Swen Lorenz. Swen is the CEO of Sarnia Asset Management and author of UndevaluedShares.com. Together with his colleagues Harold and James, that's me, he came up with the idea for Poor Millionaires. In this episode, Swen is here to talk about what he believes to be a generational opportunity for investors in smaller listed companies. Poor Millionaires is a show for people with investable wealth of $1 to $20 million. We strive to educate, connect, and inspire, to give you the tools you need to thrive and secure lasting prosperity for yourself and for your family. PoorMillionaires.com. Invest with ambition. This podcast is for educational purposes only. The information does not constitute financial advice or recommendation and should not be considered as such. Value investments and any income derived from them can fall as well as rise, and you may not get back the original amount you invested. Swen Lorenz, welcome to the Poor Millionaires podcast.
Hi, James. Pleasure to be here.
Good to see you. So we're here to talk about what you describe as a generational opportunity in the small cap market. I think we should kick off just by explaining exactly what we mean by a small cap and what makes them so appealing to investors.
Small caps are essentially smaller companies listed on the stock market. Now, the question is, what exactly is small or smaller than other companies? It really depends on who you ask, and we have our own benchmark for that. I once had a meeting with Goldman Sachs where I was speaking about opening an institutional brokerage account, and they said that any company below $6 billion market cap is a micro cap from their perspective. So that tells you a bit about different standards. From our perspective, we define small cap as anything that's usually between 100 million or 500 million in market capitalization. Now you can say whether that's dollars or euros or pounds, it doesn't really matter. That's sort of what you would generally call a medium-sized company in most people's standards. That's a small cap. It has to be listed on the stock market, which means that there is a daily price. You can buy and sell these shares on a daily basis on a recognized stock exchange like London, Frankfurt, New York, Zurich, you name it, or Hong Kong. And that's a small cap, as opposed to, for example, all these privately held companies that people are investing in nowadays through private equity vehicles or venture capital funds. A small cap is generally listed on a recognized stock exchange with a daily price.
Cool. And you and I both have quite a lot of past history when it comes to smaller companies through various newsletters and small cap research, things like that. Can you tell us a bit about your background in the market and sort of your career path and where your experience comes from?
Yeah, I have just a bit of experience, 36 years, as I've just figured out. I bought my first small cap stock when I was 14, maybe 15, I don't remember exactly. But what I do remember is that my parents had to give me permission at the local savings and loan bank in Germany to place a brokerage order for purchasing a utility stock in Germany, an electricity company, a regional electricity company. And from regional, you can immediately gather that was a small cap. Now, I've basically been a lifelong follower and advocate of investing in small cap stocks for reasons that we'll get to later in the show as well. But I have for decades now been following small cap stocks around the world. I do have a bit of a bias towards Europe because that's where I'm from, and I just happen to know a lot of companies very well in Europe. But I've always been looking at this from a global perspective, which I think is quite important because sometimes you find the best opportunities not closer to home, but further away. And then you need to be very flexible with your mindset and your skills to analyze these companies and your technical ability also to buy and sell these stocks, because not every brokerage firm offers global execution of trading. So it does take a bit, and at the same time, it always benefits from having seen a lot of things and having done a lot of stuff. And I think, in all modesty, that's what I can lay claim to nowadays.
Good stuff. And I can remember one of the first books that I read about investing was called The Zulu Principle. It was by the British investor Jim Slater, and its catchphrase was "Elephants don't gallop," meaning that these big blue chip companies, you're never really going to make huge returns. But obviously lately we've seen the Magnificent Seven, the big tech companies in the US, outperform pretty much everything else. So it's pretty much been like the only game in town. So investors have been able to invest in these, these big stable companies and achieve really good returns. So is there a sense that private investors have maybe become a little bit lazy recently and a bit complacent? They've not needed to kind of trawl their way through these, hundreds of small cap companies to find stocks that return 10 times or more?
I love the fact that you quote Jim Slater as an example because, in many, many ways, he's such a useful example to speak about. I mean, first of all, Jim Slater, as far as I remember, he became famous because he was writing about small cap stocks under a pseudonym in, I think it was the Daily Telegraph or the Times, one of the large dailies in the UK, in any case. And he achieved some extraordinary returns with the stocks that he featured in the newspaper at the time. Now, at the same time, much as that is a positive example, he was also a bit of a negative example in the sense that I have come to realize over the decades that I've been in markets that you should never limit yourself to just one asset class or one type of company, because circumstances change and the fashion of the decade, whatever happens to be in demand, that changes as well. And Jim Slater published this famous book, The Zulu Principle, which I think is long out of print now. Slater, I think, died in 2015, aged mid-80s or something like that. But he basically wrote this entire book about investing in smaller companies. So, of course, he would have talked up his own book, no pun intended, and made a very strong case that small companies is where it's at. But in the last 1 or 2 decades, we have seen what can happen and what sort of gains you can achieve with large companies. It's the Mag 7. One of my favorite examples is Apple, because I was an early advocate of actually using Apple computers. I bought one in, I think, 2001 or 2002 when no one was using Apple. So a lot of money has been made, and you could even say in a relatively easy way, because buying these big companies seemed like something that was low risk, easy maintenance, didn't require deep analytical skills. So Slater would have basically looked in the wrong place for a decade or two, or at least you could argue that with him. And I'm very much an advocate of remaining flexible. Different times require different asset classes and different approaches. And absolutely, in the last 10 years, many mega caps even were the place to be. And small caps, in many ways, were not the place to be. I argue this is going to change now, and that's the generational investment opportunity that you've just mentioned. And I think, especially in the last couple of weeks, we've seen the first inklings of that in markets, where suddenly people are seriously questioning whether US mega caps and the Mag 7 are really the way forward. And much more will happen in that regard, in my view. And I look at this from a positive perspective. There's a huge opportunity. I'm not here to trash the mega caps and the Mag 7. But yes, I could talk about this for hours. There's definitely a generational investment opportunity now in small caps.
So I think one of the barriers that investors face is that this sort of sense that small caps are kind of risky. They've got a bad reputation. There's a lot of kind of poor companies in that sector. So what's behind this kind of this perception of small caps as being quite risky and quite negative?
I think there's a couple of points that we need to unwrap individually. So let's start with, there is a lot of them. And there are some great stats that in Europe, I think you have about 1,000 truly large cap companies, but then you've got something like 17,500 small and mid cap companies. Again, it always depends on how you define these things, but broadly speaking, there is a very high multiple of the number of companies that are smaller than the big ones that everyone knows and which are the household names. And that does make it a bit of a jungle, especially in Europe, where you've got, I don't know, how many countries do we have here, depending on how you count. It's like 36 countries, and I think 27 are in the European Union. We've got, I think, 28 different languages, and you've got all these different legal systems. So whoever wakes up in the morning and thinks, I have to urgently look at Belgian small caps. And that tells you that Belgian small caps are probably not that widely followed because it's a small country. There's the language barrier. There are probably cultural differences in the legal system, in the reporting system. And that, on the one hand, makes it difficult and complex. But on the other hand, it creates opportunity because where there is, fewer people following an investment, there's a higher chance of finding something that's mispriced and where you find an opportunity simply by buying into it at a very attractive valuation relative to what you're purchasing. And I'd say that's one of the strongest arguments in favor of small caps in general, but also in particular European small caps, because there's such diversity, complexity, opacity. And I would definitely say that's much as some people say that's a bug, I would say that's a feature, and that's what we want to make use of.
And you've kind of hit the nail on the head there, haven't you? Because, from our experience, we know that, it takes a lot of time and energy to sort of sift your way through all these different companies to find, the hidden gems. And it's very time consuming. So how can a private investor hope to kind of, to take advantage of this opportunity when there are 17,500 companies listed on European exchanges alone, never mind like the rest of the world. So how does an investor take advantage of this opportunity?
So I would say that private investors are uniquely advantaged when it comes to that market because they don't have these restrictions that fund managers are generally under, which, for example, is that they can only buy into something that has a certain minimum market cap. They usually come to this entire challenge of analyzing small cap stocks with a fresh perspective. They're not shaped or limited by an institutional view or a very corporate approach. And I can say that I know quite a few private investors who have massively outperformed markets over the last years and last decades because they were able to look into, slightly more remote corners of the financial market and buy into investments that most institutional investors wouldn't have been able to buy into, or maybe go into them with a higher portfolio concentration than an institutional investor, an investment fund would have been allowed to. So much as you can say that private investors are disadvantaged in some way, I would say they can turn this into an advantage. It requires to put in effort. Whatever you put in, you get out. There's no free lunch. But at the same time, you can just as much make the argument that for most people, this is not going to be an option because they have a job, they're busy, they've got hobbies, they've got a family, and they might want to hire someone, a fund manager, who does that sort of work for them. And that can be very attractive. It's not for everyone, but for some people, this will be the perfect solution. So there, as always, there are different ways to go about it.
Yeah. So I want to talk a bit about the risks that investors face when investing in small companies. So what are the specific risk characteristics of small caps, and how do they perhaps differ from the larger companies out there? For example, financing risk is an obvious one. People don't necessarily want to lend to a smaller company that is perceived as a higher risk, a higher risk offering.
Yes, that takes us back to a point you raised earlier, which I didn't fully reply to. The perceived risk or the real risk of investing in small cap companies and their, I'd say, reputational issues. Many people will say, oh, I bought this small cap company into my portfolio in the past and it went all horribly wrong. And of course, that can happen just as much as with any other investment you can buy. Lots of people have lost money on private equity, venture capital, real estate even. And everyone will have their own story to share in that regard. But I would say it's very much down to buying quality and being very clear in what it is that you're buying into and going about it in the right way, which is a very broad way of putting it. Let me put some more, meat on the bones and be a bit more specific. Investments and their performance ultimately depend on the valuation that you pay. There's this great quote from Warren Buffett that in the short run, markets are a voting machine and in the long run, they're a weighing machine. What does that mean? It means that in the short run, prices do all sorts of crazy things, but in the long run, they they very much depend on or are driven by valuation. And there is no single more influential factor for the future performance of an investment than the valuation at which you buy it. That's not true in the short run, but if you look at it from a 10-year perspective, what you pay in terms of valuation is the largest factor determining the outcome, your performance. And there are many, many statistics about this. There are countless scientific articles about it as well. And I would argue that with small caps, what it really depends on is by quality, buy into companies that are high quality companies. And there are many ways how to define that. It could be a company with a so-called moat, which has a very strong competitive advantage compared to its competitors, if there are even any competitors. I love looking at companies with recurring revenue because recurring revenue gives you a head start into each financial year. On January the 1st, you know exactly what's coming in from your existing customers. And there are many other ways how to go about defining quality, but you need to be experienced in determining what exactly is quality and how do you judge that relative to the valuation. And then it's also staying clear of the many small cap companies that are just, apologize me being very blunt, but which are simply garbage, basically, and which are being promoted by questionable characters. And there is an inordinate amount of them out there. But that's true in any asset class. Again, whether you buy real estate or venture capital or whatever, there are always lots of people out there wanting to sell you something that you just should never put your money into. The same is true for small caps. And yet again, either you do the work yourself or you have someone doing that for you. And then it's an extraordinarily attractive market to be invested in because there is so much of these companies, so many of these companies out there. And at any given time, there are opportunities, whether that's in Europe or in the States or in Asia. It's really a global thing. And right now, that's in particular true with European small caps because on any metric you look at, they are cheap and cheap to a degree that they haven't been since 2009. And in 2009, after the great financial crisis, you could have picked up almost any European company and you did very well for a number of years. And we're back at that point now. And that's the particular opportunity that I see with small cap stocks right now.
One of the recent changes in Europe has been the regulatory changes to stock research. So this has kind of reduced the amount of research available on smaller companies, and obviously means that there are more opportunities out there where investors have potentially overlooked these companies. Do you have any kind of like go-to sources of information that you could recommend to investors who are perhaps looking for information on these companies?
Well, there's really two answers here. First of all, my real go-to resources I'm not going to share because that give everyone a competitive advantage. But seriously, I think the number one go-to resource that I would like to point everyone to is a absolutely obvious one. It's Substack. So there is now a large number of, call them private investors, professional investors, or semi-professional investors who are writing about their investing as well. And they very often write about small cap stocks. And they write about them on Substack, which is the number one go-to place nowadays to find like-minded individuals, peers, and people who are in a similar position than you are, who are sharing their knowledge and who are also, debating quite openly with their followers in Discord groups or in the comment section. And that is a veritable treasure trove of valuable information, great investment ideas, and it's all available. I mean, first of all, it is available in the first place. There's no one's limited to, there's no limit to anyone accessing this information, and it's cheap. Of course, there's a lot of them out there and you need to filter. And I'm not saying that every Substack is worth following, but that'd be my number one go-to place because that's where you read about hidden gems from people who are very smart and who are probably pursuing the same mission than you are pursuing if you want to be successful in small cap investing.
Good stuff. And we've talked a lot about the European smaller caps. Is the opportunity kind of limited to Europe in your mind, or is it kind of further afield? Can we talk about the US and Asia potentially as well?
Yes, so I speak a lot about Europe because that's where I'm based and that's where I've spent most of my life and I know the most about. But that gives me a bit of a bias that I also need to, be clear about is in a way a limitation. I'm a strong believer that there is a huge opportunity set, particularly in Asian markets, because in Asia you now have higher quality companies in large numbers. And just as Europe, they have this situation, there's a lot of countries with a lot of different languages and legal systems, and there is not enough research about these companies. So you find cases of severe mispricing, which is where the opportunity lies. And that sets it apart somewhat from the United States, where you can also find a lot of small caps, but the United States is a homogeneous financial market, one language, one legal system, a lot of competition when it comes to finding good investments. There's a lot of capital chasing after good deals. And yes, you can be a successful small cap investor in the United States, but I think the low hanging fruit is really at this stage Europe, followed by Asia. Then you can add a few outlier cases to it that are smaller. So I think Australia and New Zealand belong into that whole category as well. But these are obviously smaller markets. There may be one or the other opportunity in Africa, but that's just really on the fringes. That's not something that I would put a lot of importance on. I would say, in particular within Europe, you have to look at Central and Eastern Europe. These economies over there, some of them are doing surprisingly well and are overlooked. And yeah, there's just a lot of opportunity out there, and it's not really limited to any geography. I think the limiting factor is really how many things can you follow. And if you choose to place money with a fund manager, even if it's a team of fund managers working together, you will find that probably they just have, as I have just said, they will have a bias towards one particular geographical area or some sectors, some particular investment markers, so investment criteria. No one can follow everything. It's just too big a world with too many different investment opportunities. So a degree of specialization is always, inherently a part of the game, but that doesn't mean that outside of that area of specialization there would be less opportunities. It's just the day only has so many hours, and we all need to focus on a certain area.
Does it concern you that fewer and fewer companies seem to be choosing to list on the stock market and instead are kind of favouring the private market route? For example, there are a lot fewer companies around now, listed companies, than there used to be, because a lot of these companies are getting hoovered up by private equity, for example. So is that a threat to the sort of the health of the small cap markets?
It doesn't concern me at all. And that same argument gets repeated over and over by the media. And I have to say it's complete nonsense. And just because every journalist copies from every other journalist and, these things then just perpetuate themselves, doesn't make it true. So it reminds me a bit of female friends of mine who say, oh, there are no more good men in London. And all I have to say is, there are 8 million people in London. All you need is one good guy. Surely there's someone out there. And in a way, it's somewhat similar with stocks. So we have 17,000 or maybe 30,000 small cap stocks in Europe, depending on how you define them. And if that goes down to, say, it goes down from 17 to 12, that's still 12,000 stocks to choose from. In your normal average portfolio, you'd probably have 10 or 20 stocks. I mean, surely it doesn't matter much whether you've got 17,000 or 12,000 companies listed on a market and being part of your investment universe. You will be able to find 10 or 20 stocks among them to create a portfolio. So, no is the answer. It doesn't concern me at all. And these things also go in cycles. And we've now had a admittedly long and fairly strong cycle of companies leaving the stock market, going private or not listing in the first place. And that has indeed reduced the number of private companies, of public companies. But eventually the pendulum always swings in the other direction, and then IPOs will become fashionable again, and then the number increases. And if you've been around for as long as me, and I'm sounding like Methuselah now, but It'll go the other way again, and no, I'm not worried about it.
And is the obvious route for most investors to just find a really good fund manager to tap this market? Because obviously we've spoken about how time consuming and difficult this can be to navigate this market. So it seems to me that the easiest choice for most investors would simply be to find a good fund manager.
Yes, so I think every investor has different needs, and it's very difficult to give blanket advice to anyone. And for well over 25 years, I've been telling most people who ask me, hey, how should I invest my money? I've been telling them, just buy an index fund, because the world as a whole gets richer over time. And for as long as you save and you put money away and you put into something that doesn't go up in smoke, you'll probably be doing quite well by just putting your money into an index fund. And that has worked really well. And at the same time, there are investors who already have index funds up to their ears, or who may be looking for higher returns than what they could feasibly get from such large cap and mega cap funds in the next 10 years. To quote one now quite well-known figure, Goldman Sachs has recently come out with a study, and it basically said, because we've seen such extraordinarily good returns in large and mega cap companies over the last 10, 15 years, and because valuations for them are now so high, in the next 10 years, Goldman Sachs is only expecting them to return 3% per annum. Wow. So I think that's a fair assessment. And the question is, what are you aiming for? And if you're aiming to generate significant alpha, because you say, I really want to get ahead in life and I want my portfolio to grow at something that's certainly higher than 3% per annum, then you probably have to look at small and mid caps. And I think there's a very viable chance of earning 10%, 15%, maybe 20% per annum with small and mid caps if you manage your portfolio well. The opportunities are certainly out there. And if you want to achieve that, then you also have to ask yourself, can you stomach the volatility that is inherent to financial markets, to the stock market, and in particular also to small cap stocks? If you can put money aside for the next 3 years or 5 years, or ideally even longer, then I think small cap stocks are absolutely the place to be. And if you don't want to do all the heavy lifting yourself, then give it to a fund manager. But that is not true for everyone, and people have to speak to their financial advisor about their portfolio split. How much should you put into any individual asset class? I think a lot of people are way overweight real estate and private investments right now. So I think going into small cap stocks improves the liquidity of their portfolio, even though not many people have been thinking about that until fairly recently. But with what we're seeing in private equity right now, I think a lot more people will be asking themselves about liquidity of their investments going forward. That's a long-winded answer of saying it all depends, but the bottom line is probably yes for a lot of investors. Yes, speaking to some very good small cap fund managers is probably a good idea. And I guess someone who listens to this podcast does so for a reason. And go and investigate.
So I'm a private investor. I'm looking for a small cap fund manager. What sort of characteristics should I be looking for in a fund manager in that space?
So my favorite subject in that regard is skin in the game, which is financial market lingo for a fund manager should really invest his own money into his own fund. And in a way, I would call that just common sense. But as we both know, in the last 10 or 20 years, common sense has become even less common. And there is a famous statistic that the Financial Times published in 2016, which at the time already said, and this was 9 years ago, that less than half of the American fund managers have a significant amount of their own money invested in the fund that they manage. And since then, that has gotten a lot worse for all sorts of regulatory and cultural reasons and how corporations are managed. And I personally like to be investing with people who put their money where their mouth is. And I would ask about the skin in the game that the fund manager has. Secondly, I think I would go for fund managers who are not what you could call flashy media personalities. Are they sort of Flash Harry types who are constantly in the media or who drive around in a Ferrari? They might get a lot of clicks on the internet, but really a fund manager should be primarily locked away in their basement, looking at their Bloomberg screen, including ideally in evenings and on weekends and holidays, and focus on their portfolio. And that's something, where I obviously run a fund management business as well, which is not the subject of this podcast, but we basically take the heavy lifting off the back of fund managers so that they can really focus on their portfolio rather than on operations, compliance, fundraising, marketing, all these things. And I think go with fund managers who are modest characters, who have been in the game for a long time, have a track record that's based on a real money audited track record in the past, rather than, sort of like backdated calculations and all that funny stuff that you see nowadays. And then check, how long have they been doing that and what have they been investing in? Has it been quality companies? And if you do what I've just mentioned in the last couple of minutes, then you're already ahead of 90% of investors who are looking at funds.
So I just want to finish off by giving an elevator pitch for the small cap market. So in a nutshell, Sven, what is the case for small caps right now?
Long-term investment performance depends on the valuation you pay and also on the quality of the company that you buy into and the overall momentum of that market. And right now, you're finding the most attractive valuations of the last 15 years in small cap stocks. You have an extraordinary number of high quality companies that are completely overlooked because there's so little research on them nowadays. And I think crucially, momentum is now swinging towards small cap stocks in a way that we haven't seen in a long time. And all that taken together makes for a generational investment opportunity in small caps.
Great. It's a very exciting space. It'd be very interesting to see how things pan out in future. Thanks very much for your time, Sven.
Thank you, James. It's been a pleasure.
Thanks again to Sven for his time today. Don't forget to check out the links in the show notes and subscribe if you've enjoyed the pod. Thanks for listening, everyone.